Welcome everyone for a new AFSIA showcase today. Thank you very much for joining in. Our speaker of the day, Maxime, is already connected with us. Very interesting events, always when it comes to financing solar projects, solar equipment. And our speaker today, representing Odyssey Energy Solutions, has a brand new solution to tell you about. So I'm sure you will be learning a lot, and hopefully this will help you in your various endeavors for developing and building solar projects in Africa. So moving on, introducing our presenter today. His name is Maxime Eon. He's the Vice President of Revenue at Odyssey Energy Solutions. And he's joining us today with a very solid background in solar and financing for solar. So he's got 10 years experience specifically in the South African solar industry. He previously worked with companies such as Emergent Energy and Solar Direct. At Emergent Energy was the head of the commercial portfolio and previously also head of marketing at Solar Direct. I always like to drop in a little side note. Maxime, I saw that you are passionate about biltong and even founded a company called the Biltong Board. I don't know if we'll have a chance to address this today, but definitely something very interesting in your background. And from a educational point of view, mostly focusing on business and entrepreneurship, with a bachelor's in business and a postgraduate diploma in entrepreneurship from the University of Cape Town. So with this being said, you now have an idea about who Maxime is, but he's going to tell you about the new product, the new solution that Odyssey Energy Solution has set up to help solar professionals finance their solar equipment and solar projects in various places across Africa. So with this said, Maxime, I hand over to you.
Thank you, John. Thank you for the great intro and for the opportunity to be here today. We're delighted to have the opportunity to present to you the latest and the greatest at Odyssey. As you mentioned in the intro, I guess, every single time we speak about credit and financing, it generates a lot of interest, and looking at the numbers today, it's been confirmed again. So without further ado, let's jump straight into today's presentation. We'll be together for roughly an hour. I'll start by telling you more about Odyssey, who we are and what we do in the industry. We'll address your pain point as a developer. We'll unpack the value of our construction credit facility we just launched to market. Speaking to this pain point specifically, we'll talk more about the cost associated to the facility too. We'll walk you through the process to apply for this facility. And lastly, at the end, we should have 10-15 minutes to answer any of the questions that you may have. So we won't answer the question during the presentation, but we've got time at the end to do so. All right, so let's start by introducing Odyssey Energy Solutions. So who is Odyssey? Odyssey is the largest finance and tech platform enabling financiers in renewable energy to develop more projects faster. And we do that in two ways. We've got two major work streams. The first one is that we support DFIs and large commercial banks with our software to enable them deploy more capital in the sector. And the second one is by deploying capital for the likes of the commercial bank we support to support industry player with the short-term working capital needs. And today we're going to focus specifically on that second work stream, which is our supply chain credit offering dedicated to developers. We've got a global footprint. Personally, I'm based in Cape Town, South Africa, but I'm on a regular basis traveling to our various regions. But we've got a footprint in Kenya, in Nigeria, South Africa. We launched in India earlier this year, and we're looking at launching in the LATAM region later this year or early next year. We've been in business since 2017. So we've learned from the sector. We like to think of ourselves as solutionist, if it's a word. And I look forward to hear your thoughts and questions on our product. A few numbers to give you an idea of the scale of our operations. To date, we've got 2,600 platform members on our platform. As I mentioned earlier on, we are an ecosystem. So we provide tools and products on our platform to our users. Users may be an EPC, an IPP, a commercial bank, or a DFI, using the platform to connect with developers, or it could be an EPC looking for source of capital, looking at procuring equipment, or even tendering for an electrification program across Africa. And that platform has been running successfully now for the last 3 years, since 2017. We've got $1.6 billion of capital being deployed through our platform. So to be clear, it's not Odyssey's equity. It's capital we are deploying on behalf of the large DFI we're working with. We have partnership with in excess of 30 OEM partners. So by OEM, we mean essentially equipment manufacturers. What we've done over the years is that we've been aggregating procurement for EPCs that use our platform and negotiated best terms with these OEMs. So I know we've got a few equipment manufacturers attending this webinar, today. So should you have any question about the work we do with equipment manufacturer, please reach out to me after this webinar, and I'll be able to tell you more about it. We've facilitated to date the deployment of 2.3 million systems. We have a fully fledged asset management business too, and we are tracking the performance of 1,600 assets. And we are managing in excess of 43 financing programs on this platform too. So let's jump straight into the topic of today, which is construction credit, the latest child of Odyssey, I may say. In order to really define construction credit, one would like to start by understanding the pain point faced by developers and EPC, generally speaking. So let's define an EPC. What is an EPC really? It's an EPC can be defined as a risk vehicle. So your ability as an EPC to identify and manage the risk associated with developing and building solar project, we define your ability to be sustainable as a business and to be successful. And you have a number of pain points that you need to manage on a daily basis. And one of them is working capital specifically. That is true for every single business, you'll tell me, but even more for an EPC than in other business, purely because EPCs are cash businesses. You're constantly managing your inflows of cash and your outflows. So your ability to do that the right way will define your ability to be sustainable as a company. What we've seen as well is that what differentiates an EPC that can build 100 kilowatt peak CNI solar system and an EPC that can build a 3 megawatt solar system is very often the size of the balance sheet. So we'll speak more about balance sheet, cash flows, and inflows during that call, because that's really the core and the reason why we launched our construction credit facility. The second major pain point faced by EPCs is the mismatch between the credit line and the project cash flows. And that's true for two reasons. So A, if you need to build a solar project that's going to cost you $1 million, the rule of thumb is that you will get access to between 3 and 5 million in credit lines from your supplier. That supplier could be an equipment manufacturer, or it could be a local distributor. So you're constantly looking for alternative, I would say, sources of cash in order to attest and to account for the cash required in order to build these assets. You could do that by charging your customer a larger deposit, or you could do it by going to the bank and apply for a loan, or use your own cash reserve. That's also an alternative. But generally speaking, the size of the credit line you receive are not sufficient in order to build your asset, your solar assets. And that's why very often EPCs are forced to scale their activities, build a cash reserve in order to increase the size of the asset they can build. And the second reason is that there's a mismatch between your receivables on site, in other words, your inflows of cash, and your obligation to pay these credit lines. So if you get a 30 days payment term from one of your suppliers, generally speaking, regardless of where your project is at, and if you manage to collect payment milestones, you'll be liable to pay for that credit line. So there's a complete misalignment between your repayment obligation with your suppliers and your receivables on site. Number three, it's by definition, an EPC is a service company. So it makes it pretty hard for you to borrow from traditional lenders. Your balance sheet, you don't own many assets unless you're an IPP or you're a very large EPC. Generally speaking, if any of you has gone to the bank to apply for a working capital facility with your bank, it's a fairly lengthy process, and that process doesn't really match the transaction of our industry. We'll chat about it later during that. After you get appointed for a project. Number four, there are just very few alternatives out there to support you with your working capital needs during the construction phase of your project. Whether you are procuring or whether you're building for a solar system, you need cash and you need access to cash, I would say, on an on-demand basis. And there are very few products out there that can satisfy this demand. So we've got two main credit products that we support EPCs and developers with, respectively what we call procurement credit and construction credit. So today we're going to focus exclusively on procurement credit, but I wanted to give you an insight on both of these offerings. Procurement credit has been a product of ours for the last 2 years, which we've been running across our region successfully. And it's essentially a working capital product dedicated to bridge the financing of procurement transactions. Let's read an example of a procurement that needs to occur with a large module manufacturer. In order to procure this module, you would essentially be expected to pay a deposit that could go anywhere up to 70% of the transaction value. Then the goods would have to be manufactured, shipped in country, cleared in country, and then would have to pay the difference depending on the term negotiated with your OEM when you take possession of the good on pre-addressed terms. The pain point that you have with this type of transaction is that you would have 70% of your transaction value locked, it's capital locked in a single transaction without you having access to this equipment. So what we've been doing and the way we've been supporting the industry over the last few years is by essentially fulfilling this transaction order on your behalf, on behalf of the EPC, by taking as little as 20% deposit, pay the supplier in full, ship the goods in country, clear the goods in country, and then provide you with the ability to only pay us when you collect the goods from our warehouse to take them to site. The due diligence around this product is fairly light. We only take a view on the resellability of the equipment. In other words, we don't need to diligence you and your company. We'll take a view on the equipment. Should the entity who is using our facility default, we have the ability to resell the equipment to one of our EPC partners in our network. And procurement credit has been running successfully for some time now. The feedback we kept on getting from local EPC and developers is that EPCs needed the capital to pay us to collect the goods before getting to site. And as you know, in a typical C&I project, generally speaking, your receivables are aligned with the milestone achieved on site. So we've listened to the industry and we decided to launch construction credit. Construction credit is structured very similarly to procurement credit, but we provide you with the ability to pay us anytime during the construction phase of your project, whether it's in line with the payment milestone achieved during construction or as a bullet payment when you reach COD on site. So what is construction credit? So it's an industry-specific credit facility designed by industry experts for industry experts. I mean, as John mentioned in the introduction, I mean, I'm a former developer myself. At Odyssey, we are a team with a vast area of skills. We come from the industry, from banks, from the banking sector, so we design engineers. So we really design this product in line with the need of the renewable energy industry specifically. So we've accounted for your pain point, we've listened to the industry, and we've designed this product specifically to bridge working capital needs dedicated to the construction of this project. Number two, it's on-demand short-term credit dedicated to equipment procurement. There's a lot in this sentence. On-demand because you can access a credit facility within 5 to 7 working days. So it's really designed to match the transactional nature of our industry. Short-term because it's a capital that is dedicated to bridge finance projects and can go all the way up to 12 months. I'll get back into the terms shortly. And lastly, it's dedicated to equipment procurement. We'll always use this credit facility to procure and purchase equipment. You can't use it to pay for engineering fees or pay labor on site and so on. It's very much designed for the procurement of your equipment. Number three, it's settlement schedules that align with when you get paid. As I mentioned earlier, one of the major pain points is that there's a mismatch and a misalignment between your obligation with your lenders or anyone providing you with credit line and your receivable on site. For us, we understand that pain point and we enable you to pay us back only when you get paid by your own customers. And I mean, the ultimate result of that is that you'll never be in a negative capital position on a per project basis. Number four, we like to think that we have the industry most competitive rates for this type of facility. Really because considering the risk factor associated with the construction phase of the project, the on-demand nature of the facility, we feel that the fees we're charging to the market are, number one, digestible by the market, and number two, very much aligned with what's being offered out there, and if anything, it's actually cheaper than what you would get from traditional lender. All right, let's talk about the terms of the facility now. So we would look at transactions that go all the way up to $5 million, credit period that could go all the way up to 12 months. Again, 12 months, just to clarify this 12 months period. If your project takes 3 months to be built and you achieve COD after 3 months on site, we would expect to be paid at COD. So it's 12 months or COD, whichever happened first. We will never finance a transaction post-COD. In other words, we're not doing project financing like we traditionally define project financing. It's very much a credit facility that is dedicated to the construction phase. As you're done building your plants and building your sites, you should be in a position to pay us back, and that's when we expect to be taken out. We're always requesting a small deposit to be paid up front. So we're giving you a wide range here on these slides. Generally speaking, we're looking at 15% deposit. Should the equipment that you wish to procure is very bespoke or the risk profile of your project is fairly high, we would increase the deposit amount to the risk ourselves. Again, that final deposit amount is subject to our credit committee, our investment committee review. The cost of the facility, again, differs depending on the region we operate. But generally speaking, the way it's structured, we will charge you an upfront processing fee of 1.5 to 2%. And then you get a 1.5 to 2% monthly fee on the outstanding debt, not on your principal debt, and that's very important. So you'll see we'll deep dive into the cost of the facility shortly. If you had to work out the cost of the facility and annualize this rate, it's not necessarily 2% times 12. It's very much dependent on the milestones you've paid, because you only pay interest on the outstanding balance that you owe us. What type of security are we looking for? So there are different ways of structure it, but generally speaking, we will escrow your milestones. So we can put in place an ISPO or an escrow account together, so that as you get paid by your own customer, we want to ensure that we're the first one to get paid. The repayment of the facility, as I mentioned, can be milestone-based or bullet payment on commissioning, depending on the type of project you're building. If you are building a mini grid, you're very likely to be appointed and have a grant agreement at stake. So you'll only get paid on commissioning, in which case we would expect to be paid at the commissioning phase of the project. If you are a traditional C&I developer and you're building for a shoe manufacturer, as an example, and the project is financed by a bank, we would, generally speaking, escrow the milestone payment that you receive from the end user or from the bank in this case. And lastly, the approval time in order to get credit committee approval is 7 to 10 working days. So we want to make this facility really available to you on the fly, on demand, and you'll see that the way that the process is set up in order to access the facility, it's done extremely quickly. And by the time you're onboarded and as an EPC partner, you could essentially use this facility on an ongoing basis and as you need them on a per project basis. So why is our credit facility so unique? Number one, it's on-demand credit matching cash flow variability. And that's what we feel is very unique, and there's no alternative providing the same benefits here. We'll provide you with credit, and we'll only expect to get paid when you get paid yourself, essentially. Number two, it's completely off balance sheet because practically you don't own the equipment until the equipment's paid for. So it's not additive to your existing borrowing capacity from other lenders, or it's not impacting your credit line with traditional distributors. Number three, as I mentioned, you have flexible payment schedule. So you only pay us back, as you receive payment from your own customer. Number four, very important point, it's completely hassle-free. No heavy paperwork, no long due diligence process. You can essentially apply for this facility online and get approval within 5 to 7 working days. Number five, we're not expecting any surety or personal warranty from the funders. And number six, of course, we believe that the rates we're providing you, considering the risk factor associated with construction, are very appealing. Okay, so understanding the cost of the facility. So we've addressed the terms. You get an idea of the cost and how the pricing of the facility is structured. But let's use a practical example for you to truly understand how we price and how to calculate the cost of our facility for a specific transaction. So on these charts, you'll see that we're looking at a typical life cycle of a project. So you would start with the project development phase that can take anywhere from, I guess, a week to 2 years. We all know that a C&I project can take a fair amount of time to be closed. So it's a very broad range, again, of time it would take to develop and build a project, or at least be appointed for this project. Then by the time you're appointed, you would need to procure and plan for that project. That window varies depending on the scope, but I think 2 months is a fair average. And then you build the system. That system could take anywhere up to a month and linked to the terms of the facility we provide. In this case specifically, we're looking at a project of $1.5 million, so roughly 3 megawatts. The payment terms that have been pre-negotiated are 15% deposit, 25% on the delivery of the inverters to site, 25% when the modules are delivered, 25% on commissioning, and 10% on the handover of the project when you hand over to your customers. In this case, you would be procuring just south of $800,000, or using our facility will be the transaction value would be for south of $800,000. We would charge you a small deposit up front of $114,000, and then we would collect payments in line with the milestone that you are achieving on site. So as you can see, the first 50% is expected to be settled as you've collected already 65% of your project's value. So you would have collected in this case north of $1 million, and we're only expecting you would have paid us roughly just below $500,000, 25% when you commission your plant, and lastly the remaining balance at the handover of the project. So now, how does that look like from a typical repayment schedule? Just summarizing, the inputs here would be looking at $764,000, a deposit of 15% that you would pay up front. So we would be lending you $650,000 over 6 months with a 1.5% processing fee and a 1.5% fee per month. As you can see, your principal debt at first is $650,000. That cost of 2% is charged up front, would be just below $10,000. 2 months later, you achieved your first milestone on site, and we would expect to be paid 50% of the deployed facility. So you would pay us $325,000 plus 1.5% of 650,000 over 2 months, so 19,500. 2 months later, you achieve your next milestone, where we would collect 25% of your remaining of the principal debt. So in this case, $162,500, and so on during project delivery. So over that project life cycle, that last 6 months, you would have paid us, the cost of the facility in total would have costed you $43,000 or $44,000, which is 6.75%. The reason why it's 6.75% is, again, is that the value or the cost of the interest charge are calculated on the amount of the outstanding debt and not your principal debt. And it's very important to understand that, because we've seen other products in the market which would charge you interest on your principal debt regardless of the settlement received. Now let's look at conventional cash flow tracker. Again, same example, $1.5 million. The equipment cost for that project. So the selling price of the project is 1.5 million, and the equipment cost is 1.2 million. In this case, you're procuring the entirety of the equipment cost on 30 days terms. You essentially generating inflows of cash linked to the payment milestone negotiated with your own customers, and then you got your outflows, right? So in this case, we're comparing cumulative inflows versus cumulative outflows. As you can see, if you add 30-day terms with your suppliers, and that you would have collected the goods prior to starting on site, you would have 30 days on site to pay back your suppliers. You would essentially run your cash flow for that project specifically negatively for the first 3 months out of the 6 months of the project. So if we put that onto a traditional cash flow chart, you will see in orange is your cumulative inflow, in blue is your cumulative outflow, and in yellow right at the center is your net cash flow for that project. And that's really a pain point for an EPC, right? So you could run practically a single project negatively, but when you start building multiple projects simultaneously, and you run this project on a negative cash flow curve, I mean, the issue becomes much larger, and there's a cost associated with that. So that's really the pain point we're addressing, is how to ensure that you can keep a healthy balance sheet overall for your business, but more specifically on a per project basis, how do we support you to flow this cash flow positively during project delivery? Now we're looking at the same project using our construction credit facility. $1.5 million project. You'll be procuring just below $800,000 from us, and we assume that you're still procuring $440,000 from a traditional distributor or equipment manufacturer, because you may opt to use our facility not for the entirety of the project value. Essentially, you could procure from your DB board and your mounting structure from the traditional distributors, and only use our facility, for instance, for inverters and modules. Again, that's just an example. Here again, we're comparing cumulative inflows versus cumulative outflows, and as you can see, you only expected to pay back this facility as you get paid by your own customers. Obviously, you have that 30-day terms facility that get debited, that you have to pay out essentially after 30 days. But generally speaking, if you're looking at your net cash flows over the 6 months construction phase of this project, you'll be floating your cash flow positively. And that's really one of the main benefits of this construction credit facility. Yes, you may think that you are forfeiting some of your margin, but again, I think it is negligible considering that you'd only apply our construction credit facility to a portion of your BOQ, and lastly, you're running this project with the reassurance that you'll be able to deliver them without running into cash flow issues during the construction phase again of these projects. All right, let's look at the transaction flow and how it would work. What you would need to do essentially to apply for this facility. Number one, you will need to pre-qualify. So we'll share a link in the thread of this webinar where you can go onto our platform, fill up a form, and pre-qualify for the facility. By the time you've filled up the form, within the next 2 to 3 working days, someone in our team will contact you to set up a meeting, just an exploratory meeting, to get an understanding of your need, your company, and whether or not we'll be able to support you. By the time you've pre-qualified, there'll be shared login details. These login details will be used by yourself to onboard yourself as a company. That's the very first step. That first step is obviously painful. Like any single time you need to apply for a credit facility somewhere, you'll have to share, your latest audited financial statement, management account, and just very basic information about your business for our teams to generate an understanding of your technical capabilities, generally speaking, but also of your ability to pay us back. If you've borrowed from traditional lenders in the past, it's generally a good sign that you are a financeable business, and it will give confidence to our credit committee to support you with our credit facility. So once you're onboarded, you are on our platform, and you can essentially just apply for the facility on a per project basis. So that step number 2, which is essentially your very first step, is a one-off step. And once you're on our platform, you're an EPC partner of ours, and you can start really share project details, which is taking me to step number 3 here. Once you're onboarded, we'll take a view on an individual project basis. Again, on the platform, you can share your signed cost proposal or your signed EPC agreement, your grant agreement if you are joining an electrification program. We want to have a look at your BOQ, quotation from your suppliers, whether they are local distributors or international OEM. So here again, step number 3, without getting into the detail of the list of the requirement we have, is really for us to generate an understanding of the project, the risk profile of the project, the equipment requirements, the size of the credit facility we are expected to disburse. And lastly, also take a view on your off-takers. Who is the ultimate buyers of this system? Because as you know, your ability to pay us back is directly linked to your ability to collect payment from your ultimate buyer. So we take a look on the takeout counterpart that we have on the other end, who will be buying this system. Number 4, once we've onboarded you as an EPC, we've diligenced the project, we will issue a quotation. That quotation is essentially a 2 to 3 page contract, where we'll give you the cost of our facility, the exposure we're happy to take on any given project, and we'll give you a repayment schedule. You accept the quotation by paying us a deposit, in which case we pay the supplier in full, enable you to take collection of the equipment or get that equipment delivered to site. You build your project, you pay us as per the terms specified in a construction credit quotation and contract essentially. And lastly, the transaction is closed when the entirety of the facility has been paid back to us. Here's a quick look at our platform and what you can expect to see once you'll be given login details. So you'll have what we call a program overview page, which is again reiterating the terms of the construction finance facility, may address any of the questions you have about our product, where we operate, and so on. That's your company profile sections, where you'll be uploading your AFS, your entity's name, details about the directors, and so on. And lastly, that's the credit platform project page, where you can share project details. And again, you can share multiple project details simultaneously. Just bear in mind that we won't be able to deploy the facility for your projects until you are fully onboarded as a company. That's it. That's all I have for today. I think we've got plenty of time for Q&A. I've seen quite a few questions coming in the chat and the Q&A box.
Yes, thank you very much, Maxime. Indeed, we have already received quite a lot of very interesting questions.
Yeah.
If that's okay with you, maybe you can just stop sharing your screen, so you and I will be showing in big on the listener screens. Let's go straight to it while other people drop some additional questions. First question from me. In your first slide, you mentioned that you have 1,600 assets under monitoring, and also you mentioned that you have like 2.3 million systems deployed. Can you please explain how those two numbers relate?
Sure. So the Odyssey part, one of our activity we've got, as I mentioned, we've got a fully fledged asset management platform. So essentially, our department is made out of design engineers and asset managers, where we are servicing large EPCs with hardware and software to track the performance of assets post-commissioning. Whether you are an O&M engineer that needs to operate sites or a bank who wants to keep an eye on the financial performance of the assets, our platform is currently actively monitoring and tracking the performance of 1,600 solar assets. That's what that number speaks to. It really speaks to the number of assets we have under performance management. The 2.3 million assets speaks to the number of grid connections we have enabled. So that's including CNI projects and mini grids that we have facilitated the deployment of through our I would say our financing program and our different credit offering.
Thank you very much. Next question from Sola from Nigeria. We've got a lot of listeners from Nigeria today. Thank you so much for joining. This is more of a clarification because you already touched on this on one of the slides, but Sola still had a question. If you could please explain again, what is the difference between procurement credits and construction credits, and why is this important for the EPC companies listening to us today?
That's a very good question. So I guess the fundamental of both products are the same. We provide you with working capital dedicated to bridge finance the procurement of equipment. Procurement credits, the difference is that with procurement credit, you'll be expected to pay for that equipment before you collect the equipment from our warehouse, right? So the due diligence around procurement credit is very light. We only take a view on the equipment itself and its resellability. Construction credit, on the other hand, will still procure for you, but we provide you with the ability to pay us back during the construction phase. So you take possession of your equipment without having to pay for the balance of the credit facility, because you would have paid a small deposit upfront, and you can really pay us back in line with the payment milestone collected during construction, or I guess the grant agreement and the grant you will receive on commissioning of these plants if you are in Nigeria and building under the DS program. Yeah.
Question about your competitiveness with other providers of funding. Question from a listener from Kenya.
Yes.
Kenya is one of the countries where commercial banks have a bit more appetite to finance solar projects compared to many other countries in Africa. And the question, if I may rephrase it like this, is how do you compare with offering from commercial banks who may be financing specifically solar projects?
Well, so we're very active in Kenya. We've got a partnership specifically with I&M Bank, just for reference purposes. So the reality is that Kenyan banks do project financing, right? But very few are willing to actually be exposed to construction risk. In other words, to disburse during construction phase and to pay your milestones as you achieve them on site. And what happens is that there is a due diligence process which is quite long. So in order to get that project finance approved, it will take at times 6-7 months. And very often, by the time you get funding approval, that project is gone and doesn't exist anymore. Now, when it comes to the fees, to go back to the original questions, it's hard to compare our fees to anything, because there's nothing quite like our product out there. You may be able to apply for a working capital loan with your banks, but it will be on balance sheet secured loan. You'll have to sign a suretyship. And again, the due diligence process associated to get this facility released for your company is fairly lengthy too. So you may tell us that our fees are therefore higher than the alternative, but let's define the alternative, because I don't think there's anything quite like that when it comes to that on-demand nature of the financial product.
So you've just mentioned that you're very active in Kenya. We've also highlighted many listeners from Nigeria, which is another country where you're very active. Can you please tell us, I mean, are Kenya and Nigeria the only two countries where you're active, or do you provide this kind of solution for a project anywhere in Africa?
We will look at any projects, I would say, in Africa. We have a preference to operate directly for projects within Nigeria, Kenya, and Southern Africa, because we have entities in all these countries. Nonetheless, we'll take a view on projects outside our business hubs and decide on a per project basis. There's a lot that needs to be considered. If we had to provide credit for a project in Chad, for instance, where we're busy looking at the moment. So we can't say, yes, we will entertain credit transaction outside our business hub, because there's a lot that one need to consider before providing credit. But we've done it. So yes, we have done it, and we will do it, but it's really on a per project basis.
Very good. And I think that answers the question of Taha, who was asking about specific projects in Tanzania. And so if I may rephrase you, it's just a question of EPCs to get in touch with you, submit their projects, and then enter in case-by-case discussion with you, correct?
That's right. Yeah, that's correct.
Still on a case-by-case basis, we've had several questions about whether or not this financing is per project only, or can it be also considered for a portfolio of projects? I mean, there's many EPC companies out there who are in touch with one company, one end user, one project, or a group of similar off-takers. How do you address this kind of need?
It's a very good question. It comes down to the offtake basically. So it could be a single procurement transactions dedicated to and that equipment would be used on a multitude of projects. But if you have multiple off-takers, then we would have to escrow multiple transactions. So we could we could practically provide credit for a large transaction, and that transaction will then be used across multiple projects. But from a due diligence standpoint, we need to review each project individually, specifically if the ultimate buyer or the end user is different from one project to the next.
Very good. And we've got several questions about risks and default. But before I switch over to that more negative part of the deal, we've got another question from Sola again, asking about the kinds of projects that can be financed through this facility. Is it only for CNI projects, or is any kind of large scale also included, residential, and maybe even SHS, for example?
Yeah, so other really good question. From a technology standpoint, at the moment, we focus almost exclusively on solar, purely because, as I mentioned during the presentation today, is that one way we have to de-risk ourselves is that in the case of a default, we have the ability to resell the equipment. And the bulk of our network and our platform partner operate within I would say, the solar sector, so solar PV specifically. From a type of project nature, so technology would be solar, whether it's CNI, hybrid, grid-tied, we'll look at any type of scope. And from the type of project specifically, we'll look at large residential, CNI, small utility scale, as long as it fits the criteria of the transactions, meaning that the ticket size doesn't exceed $5 million.
And just on this point, to bounce on this, Andreas had a question. We understand there is like a maximum ticket size, but is there anything like a minimum ticket size?
Yes, we haven't really officialized one, but the reality is that we won't. I mean, we could look into it because, as I said, it hasn't been formalized just yet because the facility is still new. But we don't want to go anywhere below $50,000. 50,000 US is really the minimum we'll look into.
All right. Then we are moving to the questions of Farid. Farid anticipates risks and wants to know everything about default, foreign exchange implications, things like this. So let's start with default. Can you tell us what exactly happens in case of default? Whether it's a default from your direct client, the EPC company, or actually from the end user, not paying the installer.
Yes. So the way it works is that on what we call the construction credit quotation you receive, you'll be given very specific terms in terms of the tenure of the facility. You'll be given, let's say, 6 months, 8 months, 12 months, depending on the project you're building. At the end of that of the tenure, you have a penalty period kicking in, where you'll be charged a set amount daily for not paying the facility. That set amount is really here as a penalty and to create a sense of urgency for the EPC or the borrowing entity to pay us back. Roughly, generally speaking, this is 0.2% per day. So it is high. We're very much aware of that, and it's really again to create a sense of urgency. If you're not collecting, if you're having issue collecting payment from your own buyers, generally speaking, what we've seen EPCs deciding to settle the facility out of their own cash account to avoid getting into this, I would say, this penalty period. That's the very first step. The last step, and I would say the last recourse we have, is to collect the equipment. As I mentioned earlier on, we remain owners of the equipment we procure for you until the facility is fully paid for. So legally, we have the right and come to go and collect the equipment should the EPC really default. It's not something we've ever had to do. It's not something that we want to do in any case. Very often we enter into negotiation with the EPCs, and very rarely we've had to charge the penalties. We work. If you run into issues during project delivery and you are not able to collect payment from your own customers, we'll enter into a negotiation phase, and very often it ends up very nicely. It's just we need to have these contract terms in place, yeah.
And what about foreign exchange? Because this equipment is purchased in USD, while the end user will be wanting to pay in local currency. We've seen some cases recently of very high fluctuations in terms of foreign exchange. How is this being how is this being addressed?
So for the region we mentioned, Kenya, South Africa, and Nigeria. So we'll accept local currency. We'll accept Naira in Nigeria. We'll accept Rand in South Africa and Kenyan shillings in Kenya. But the final transaction price is always going to be pinned to the dollar, right? So on the day you have to pay for the transaction, we'll take the day rate, we'll pin that rate on the day, and this define the value, the outstanding amount you'd have to pay us. It's pinned to the dollar.
Is there any other risk associated with this transaction that you think it would be important for the listeners to know about? Default, we've mentioned, foreign exchange, you've just addressed. But is there, based on your experience, maybe some other aspects that installers need to keep a close eye on while they start working on their projects and before they get in touch with you?
I think it's very important for the developer to take a view on his own risk profile, right? And the risk profile of his off-takers. Don't apply for the credit facility for any project you wouldn't finance yourself. We're not here to absorb risk related to the off-take or the ultimate buyer of a project. We're really here to bridge finance your working capital requirement. So any project you wouldn't take on by yourself as a developer, I think don't take them to us purely because it's very likely that the risk profile is too high and we'll come back to you with a negative answer. So it's more about showing common sense around the projects you're willing to use our facility for, And once you're confident in your ability to collect payments, then come and apply for the facility. We'll work with you on that. Yeah.
All right, we've got really like a lot of questions. It's a bit tough to make selection. Yes, another question. We know that the solar panels have reduced in price drastically over the last decades. The same kind of downward trend is happening with storage, so that the remaining equipment tends to have a higher percentage now in the overall installation.
Yeah.
What part of the equipment of a solar installation is being covered by this facility? Solar panels, of course, storage, of course. What about mounting structures? What about the remaining BOS? These other elements which tend to represent a higher and higher percentage nowadays.
Very, very good question again, and there's no one size fit all. And I'll tell you why. So essentially, it all comes down to the takeout counterpart that we have. Let's take a look at a project being built under the DAS program. We know we've got reassurance that the grant will be deployed and that the funds will be coming in which case, we're very likely to finance the bulk of a BOQ, of a bill of quantities. So going back to your questions, mounting structures, even cables and other equipment will be a lot more likely to finance, yes, the main equipment and more. Now, if we unsure about who's coming on the other end, who will be paying for the project, and there is I would say an augmented risk in our ability to collect payment, we will most probably restrict the credit facility to the main equipment, where there would be an alternative use for that equipment in the case of default. As you know, if we are financing cables that have been used and connected, it's very hard to resell secondhand cables. So it all comes down to the takeout counterpart and our ability to resell the equipment. So again, not a straightforward answer. We'll take a view on the main equipment for every single transaction, not a problem at all. Main equipment being batteries, inverters, solar modules. And then we could take a view on an individual basis for the remaining of your BOQ, and I would say more bespoke or the smaller items on your bill of quantity.
We've got a lot of EPC companies listening in today, but we also have different kinds of companies listening. And the next question is coming from Mohammed, who obviously works for a wholesaling business slash distributor. Is your facility also accessible to such kind of business?
It is, yeah. So as I mentioned today, I think we work across the value chain. So we work with distributors, we work with OEMs, we work with EPCs. So today we're really focused on the credit offering we have designed for EPCs, so for a buyer, essentially speaking. But we do have a similar facility for distributors that you can refer to as, trade financing or supply chain credit. And we have variation called packing and buyer's credit. So we have partnership with distributors in the various regions. I would encourage Mohammed to engage with us after this webinar so that we can talk about it in further details. Yeah.
We've got a question, next question from Terence, actually from Terence and another anonymous listener. That's also a possibility to drop off a question. You mentioned that this facility covers pure construction costs. So it doesn't cover studies or engineering services or things like this. But what about land? If purchasing land is part of the entire construction process?
Yeah, it's dedicated to equipment procurement. Anything that falls outside the equipment category, we won't be able to finance. Maybe in 6 months' time, it will change, or in a year time, but at the moment, the credit facility is dedicated to the procurement of equipment.
Next question from Uwe. Uwe, if I'm not mistaken, is in Ghana, and is wondering about your KYC process and due diligence to accept or reject a request, especially in the context of a newly set up company. Our companies reaching out to you do need to have an existing track record, or is it still possible for them even if they are totally new in the business?
Yeah, it's a difficult one because we want to support new businesses. We've seen so many new businesses that do have the skills, the projects, and the ability to, to build these projects. The reality, it's very hard to do a risk assessment on these players, right? So it's harder for a new entity to apply for the facility. I think that's the short answer. On the other hand, if you are again an entity in Nigeria who's been appointed a project under the DES program and you got a grant agreement at stake, we'll support you because we have confidence in our takeout counterpart. But the short answer is it is harder for a very new entity because you may not have a track record of project built. So it's very hard for us to build an assessment around the skills and the abilities you're hosting in-house, but also you may not have audited financial statements or management accounts ready. And for that reason, it's very hard to diligence you as a company. Yeah.
All right, I'm looking at the time and I see that we've been shooting a lot of questions. We're almost 1 hour in, so I'll ask you 2 more questions if that's okay with you. First question from Klaus. So Klaus recognizes that this facility is a great solution for cash flow challenges of many companies. But then again, in many cases, the end users are often still not in a position to pay off cash for an installation. They ask for to be able to get some discount on what they would otherwise pay to the national grid and have some kind of repayment plan spread over 3, 4, maybe 5 years. Can your facility connect with this kind of request? And if so, how?
Another really good question. Again, I'm really impressed with the quality of the question because they're super relevant. So we would not provide construction credit on the back of a PPA. We've had a lot of queries like this where companies are selling project on a lease to own model. So in other words, they'll get paid back by the end user, I would say the ultimate consumer of the power over a period of time. And we've had companies asking us if they can actually spread the payments of the credit facility on the back, or at least schedule the repayment on the back of the lease to own model or contract they signed. We can't do it as it is. As mentioned earlier on, we need to be taken out on COD. The way our facility is designed and structured cannot support this type of project. If you are in South Africa or in Kenya, we may have alternative. As I mentioned, we are in partnership with I&M, where we've been looking at projects of such nature and that have been structured this way. So again, I didn't get the name of the person asking the question, but I would encourage this person to engage with us separately, and we can chat further about this.
Very good. And then last question, and then I need to jump on my charger before my computer dies. Chris has a question about mini grids. Have you already financed mini grids through this facility? And is there anything special? Because we know mini grids very often come with RBFs, result-based financing. How does this impact or change maybe the life cycle of the facility specifically for mini grids?
Yeah, we come from the RBF background. So the facility, in fact, was built on the back of the DES program in Nigeria, and it was expanded later on to the CNI space. So yes, we are financing mini grid on the basis that the EPC can submit a grant agreement from RIA.
Maxime, once again, thank you very much for this great presentation, and I wish you an excellent rest of the day.
Likewise. Thank you so much, John, for having us, and thank you to everyone who attended the webinar today.